information discussed in this presentation is current as of the date noted and is for informational purposes only and does not intend to address the financial objectives, situation, or specific needs of any individual investor. Any information is for illustrative purposes only and is not intended to serve as investment, tax, or legal advice, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Results will vary, and no suggestion is made about how any specific solution or strategy will perform in reality.
All right. Thank you very much, Ryan. So I want to start by thanking Ryan and Amelia for all the coordination and all the effort they put into putting this webinar together. I also want to take a minute and thank Brett Winnefeld, who did a majority of the composition of the slides and locating and incorporating the graphs that we're going to look at today. I do want to mention that our purpose in creating this slide deck was to make it very visual. There's a lot of graphs, there's a lot of tables. In some cases, this may be a bit overwhelming, so we've tried to add arrows and special emphasis to help kind of point your attention to the right places. But we wanted it to be a lot more visual, so that way you can look and listen to the conversation and be less concerned with kind of reading through the script of the slides. So I also want to stress before I get started, the portion of the disclaimer that mentions that this information is relevant and valid as of the date that we're presenting on. So I'm going to talk about what's happening in the markets and the economy through the end of the year, through December 31st. What I'm not going to touch on is what's happened in the last 3 weeks. So there has been a lot of change and a lot of development in the last 3 weeks, but what we're really focusing on for this presentation is what happened through the end of 2024. So along those lines, there are going to be some things that you may have questions on that I'm not able to address here. And I do want to encourage everybody to put questions in the chat. And since I'm going to be moving through quite a bit of information, if there is something you'd like me to go back to at the end, please put that in the chat as well, and we can always take an extra minute to address it. So the first slide, when we do a market update, it seems like a very natural place to start by talking about the stock market and specifically the S&P 500 as representing the market. So the thing that I like about this graph and this table is that you can see very clearly when the market was in an expansion, meaning these green lines are sloping upwards, and when it was in a contraction, and of course they're sloping downwards. So what we see towards the right-hand side of the graph in recent times is that we've been in expansion since 2022, since about approximately October of 2022. And to add sort of emphasis to this expansion and how quickly the market has expanded, in the last 2 years, being 2023 and 2024, the S&P 500 has grown by more than 20% in both of those years, which is a significant anomaly that they were 2 years of strong growth in a row like that, but also just simply the magnitude of the growth has been well above average. So you can see the little red arrow kind of drawing your attention to the end of 2024. We ended the year just below 6,000 points for the S&P 500. We see the P/E ratio, or the price to earnings ratio, is about 21.5. And I'm going to talk a little bit more about that because that's an important part of what we think the future may hold. But we also see the dividends right now on average are a little below where they have been previously. And the 10-year treasury rate is pretty well in line with what we've expected and what we've seen in these previous expansions. So I do want to point out that if you look at the slide and you look at the slope of the green lines in these expansionary periods, you can kind of see the difference between periods where we grew consistently but in a slow, stable fashion, and periods where we grew very quickly over a very short period of time. So this brings up an important point, and one of the concerns that I'm going to talk about actually on the next slide, mentioning that the P/E valuation of 21.5 is a point of significance is because when we look at this metric, we look at this valuation over time, you can see that right now we are in the higher range. We're above average. So if you remember statistics class from back in the day, the average kind of gives you sort of where we fluctuate around, but we don't exist at the average very much. Most of the time we observe points that are about one standard deviation above or below. And right now we are in excess of one standard deviation. So you can see there were other periods historically on this graph where this valuation ratio was at a similar level, but the average is well below where we are today. So you may wonder why that's of significance. The P to E ratio is one way of sort of capturing whether the stocks on average are overpriced or underpriced or right where we expect them to be based on how the underlying companies are actually performing. So right now, it looks like the market as a whole is overpriced. Now we're going to see in the next slide that a lot of this is actually driven by a select few companies. I apologize. The slide after this, we'll see that, but we're going to get to that in a minute. So this overvaluation is driven by a small group of companies you may have heard or you may know as the Magnificent Seven. But before we step into the Mag 7 story, I do want to take a minute to address this previous slide, please, Ryan. So one of the things that it's important to understand about the stock market is that there are different time frames that are in play. So in the short term, on a day-to-day basis, we see the market responding to, say, economic reports on inflation or unemployment. We see the market responding to earnings reports. When a company publishes their earnings for a previous period, their stock may go up or down. We see the market responding to news, whether that's a policy or a government-based news or something within the companies themselves. But even though we have these kind of short-term fluctuations, in the long term, on average, the stock market tends to move or tends to be very highly correlated to the actual performance of the companies themselves. So there is some speculation in the short term. Folks are trying to anticipate what the future may look like. But over the long term, we see the market grow consistent with the earnings and the revenue growth of the companies themselves. So this isn't necessarily always true. There are periods where these two lines diverge, where the forward earnings estimates and the actual performance diverge, like in 2022. But a lot of times that's the result of some major market failure, such as historically high inflation or historically high unemployment, things where the market isn't working the way it should or the way it's intended to, we'll see deviation. But if you look at this chart for the last 2 years, it's been a pretty solid correlation that as companies are more successful on the earnings side, on their actual performance, they tend to be rewarded for that through a higher stock price. So Ryan, if you want to jump to the next one. That brings us back to the Mag 7 story. So the Mag 7 story is one of a very unique group of companies that have, in the last few years, really driven the S&P 500 and the stock market and a lot of the conversation around investing in general. So I'm sure everybody is familiar with these, but just in case anyone isn't, I do want to list them off real quick. Apple, Amazon, Meta, Google, Tesla, Nvidia, and Microsoft are the 7 companies that we're talking about when people talk about the Mag 7. So you can see from the red arrow that we put into the table that the Magnificent Seven tends to be driving the majority of performance, at least for the last 4 years. When they do well, the market does well. And when they do poorly, the market does poorly. This in itself isn't necessarily a bad thing. Throughout the history of the S&P 500, there have always been dominant companies. But one of the problems with having a small collection of very powerful, very dominant companies is that this isn't necessarily sustainable, right? A much more sustainable stock market is one where the gains and the success is broadly spread out. You see a lot of companies doing very well, as opposed to just a few companies doing well while everyone else is maybe underperforming. So we may look at the Mag 7 and say, well, that's really concerning. Those 7 companies make up such a big portion, and their performance is driving so many other factors. And we may immediately think that that's unjustified, or that that's a sign of danger. But in this case, the 2 charts that are to the right on this slide are actually trying to emphasize the fact that there's a good reason why the Mag 7 is standing out from the rest of the crowd. If you look at their actual profit margins, which are the green lines or the green bars, and you look at that in comparison to the rest of the market, which are the blue lines and blue bars, you see that part of their dominance isn't just coming from speculation, it isn't just coming from an enthusiasm for these companies, but it's actually being driven by the fact that they are exceptionally profitable, they are generating exceptional amounts of earnings, and the underlying companies themselves are simply performing extremely well. So although there's definitely concern when a small group drives the market, if that small group sort of, I guess you could say, has earned that status, has earned that position through their performance, it's a little less concerning. If you'll jump to the next one for me, Ryan. So this table has a lot of information, and I know it's very easy to get sort of overwhelmed by all of the data and all the numbers in here, which is why we created this red box to draw your attention to simply the performance of the individual sectors inside the S&P 500. So in the last quarter, we saw that a couple areas performed really well, but the majority of areas struggled. A lot of that struggle came towards the end of December, but in general, what we saw is strength coming out of areas like consumer discretionary companies and communication services, which I have to mention, these contain some of the Mag 7. So Amazon and Tesla are both in consumer discretionary, and Google and Meta are both in the communication services category. So although these categories performed well, at least some of that performance was again driven by the Mag 7. If we look at the year to date, so all of 2024, we see those same areas performing well for the year as a whole. We also see the technology sector, which contains the remainder of the Mag 7, performing well. And we see a couple sectors, a couple areas that have actually lagged behind the rest of the market. So specifically in the fourth quarter and in 2024, we saw healthcare struggle. We also saw the materials sector struggle. And for those of you that aren't super familiar with these terms, the materials sector is very closely tied to manufacturing. And so as we saw in the last 2 quarters of 2024, manufacturing was going through a difficult period and was struggling. And by extension, the companies related to manufacturing in the US were also struggling. So I do want to point out one last piece. And this is, if you look all the way to the right, the S&P 500 index as a whole gained about 2.4% in the fourth quarter alone, but gained 25% over the entire year. So again, I mentioned 2023 and 2024, both had exceptionally strong performance, both exceeded the 20% threshold. And this 25% is actually in reflection to it, or in addition to a very difficult fourth quarter. So there were a couple big drops in the market. There was some struggles towards the end of December. Um, and despite that, even with a very difficult, very sort of low performing fourth quarter, the market itself still pulled out a 25% gain for the year, which is exceptionally good. Sorry. Ryan, do you mind getting me to the next one? So when we talk about stocks, there are a couple different dimensions that we break the stocks into to get a better understanding of how subsegments or certain areas within the market are performing. So the first dimension is whether we're talking about a value stock or a growth stock. Growth stocks, very simply put, are companies that we expect to grow very rapidly in the future. They're reinvesting a lot of their profits and a lot of their performance back into the company, and the market is anticipating that they'll continue to grow at a high rate. Value stocks tend to exist on the other plane, where this is a company that looks like at its current price, it is a very good value. It's possibly a really good company that's being overlooked, or possibly a company that has lots of promise, but based on their actual financials, their stock price isn't reflecting their actual performance. So growth and value are one dimension. The size of the company is the other dimension. So of course, it's pretty self-explanatory. You have small companies, medium-sized companies, and large companies. We tend to view small companies as being more volatile. So there's a lot more sort of up and down in the stock price for small companies. And we tend to view large companies as being more stable, more well established. This doesn't mean that large companies can't struggle and small companies can't be successful, but it just means in general we tend to see more volatility among the smaller firms and a little less volatility among the larger ones. So the point of the tables here is to just demonstrate that across these two dimensions, the size of the company and the growth or the style of the company, we see pretty significant differences in performance. So in the last year, we saw large growth-oriented companies outperforming the other groups, and we saw small value-oriented companies performing the worst. Now, this doesn't necessarily mean that growth companies are where you should be investing, or small value companies are the best deal in the market, but it does mean that throughout the year and over the last 10 years, there has been a relatively consistent premium or advantage to these larger growth companies. That doesn't mean it will always persist or it'll always be the fact, but it does mean that right now, this is what we're currently observing. Ryan, do you mind hitting me? Awesome. So, growth versus value. This is an important dimension because there is no consistent 100% of the time winner across this dimension. There are times when growth stocks are outperforming, and there are times when value stocks are outperforming. So one of the important observations is we tend to see value stocks outperform during downturns, during recessions. Value stocks tend to endure a little bit better. They don't lose as much, or they're not as volatile as the growth stocks in that time. And we tend to see value stocks perform better when interest rates are at a high level. In fact, the higher the interest rate, the more advantage value stocks tend to receive. Part of that is that a lot of growth is actually funded by debt. And as interest rates go up, the debt becomes more expensive, and it becomes more expensive to grow the company and more difficult to sort of beat those costs in terms of your profit margins. This brings us to interest rates. Of course, interest rates have been a huge part of the economic conversation in the last year. In the last 12 months, in fact, actually from September through December, the Federal Reserve cut the Fed funds rate by 100 basis points. By a full 1%, they dropped those interest rates. So it's important to remember what the federal funds rate is. It's essentially the interest rate that banks or large institutions charge each other to borrow money overnight. So it's a very short-term focused rate, but the intention is that if the Federal Reserve can influence the short-term rates, then those rates will by extension influence the intermediate and the longer-term rates. So they move the lever on the short term, and they expect it to play out through the rest of the yield curve. So why does the Fed change interest rates? It's a really simple story. The Fed has what we call a dual mandate, meaning that they're responsible for maintaining stable prices. They're also responsible for maintaining full employment or unemployment at a very low level. So the reason they change interest rates is when one of those two mandates is not functioning correctly or is outside the safe range for observation. So if inflation is higher than they would like it to be, typically they'll raise the interest rates to try to bring the inflation down, slow the economy, bring the inflation down. Usually if unemployment is higher than they're comfortable, then they'll lower the interest rates. They'll cut rates to stimulate the economy and to help reduce the unemployment. The reason this year has been so interesting is because starting in 2022, the Fed raised interest rates at an incredibly rapid pace up to a relatively high level, given where interest rates have been over the last 20 years. And this started to pretty effectively bring inflation down. The concern was that in the summer of 2024, it looked like unemployment was starting to struggle. The employment rates were worsening, the unemployment rate was worsening. And so the Fed decided to start cutting interest rates and shifting their focus from fighting inflation, which seemed to be going really well, to fighting or preserving employment, which looked like it needed a boost. Now, where we are at the end of the year, at the end of 2024, some of that's being called into question. So there were some strong unemployment reports that showed the labor market doing well. There were some questionable inflation reports that showed the fight with inflation may have stalled. And so the Federal Reserve, towards the end of December, released their projections for 2025. And in their projections, they showed a better than previously expected unemployment rate, and they showed a worse than previously expected inflation rate. So at this point, the market immediately began to wonder, or at least to doubt, whether the Federal Reserve was going to cut interest rates in 2025 and what exactly the monetary policy would look like. So with that said, this chart is important because at this point, the labor market seems to be doing relatively well, definitely better than we expected in September. And so the focus of the Federal Reserve has very much shifted back to the inflation conversation. So you can see that we sort of zoomed in on the last couple of years. And the reason that we wanted to draw your attention to inflation over the last couple of years is because you can see that up to that point, there was a pretty steep downward slope. The inflation and the rate of price increases was falling up until about the last 6 months. In the last 6 months, we saw that this fight against inflation seemed to stall out. It seemed to get to a point where it just wasn't falling. It was still fluctuating a little up and down, but it just wouldn't move below or wouldn't move past that point. So with that in mind, the Fed's focus has to shift. If the Federal Reserve is going to be changing interest rates based on inflation, and inflation isn't necessarily getting better or getting worse, then there's a lot of reason why the Federal Reserve may not want to change rates right away. They might want to pause take a little bit of time to see where inflation is going to go before they make any more rate changes. If this inflation should pick up, then we would expect the Federal Reserve to stop cutting rates and, in a more extreme scenario, maybe even raise interest rates in 2025. If the inflation resumes its descent and begins to move back towards 2%, we could actually see interest rates cut 1 or 2 times, even more if there's a lot of progress, although there's hesitancy that may be the case. But we may see a couple more interest rate cuts in 2025 if the inflation fight seems to be going well. If you'll hit me with the next one, Ryan. So there's a lot going on here. And what I wanted to draw your attention to is, of course, the right-hand side of this graph, which is what's happening right now, and specifically the dark blue portion of these bars. So each of these bars represents what we would call a deconstruction of where inflation is coming from. So the dark blue, almost purple even, color is coming from shelter inflation, meaning the cost of housing and the cost of rent has been increasing at a significant rate and has actually been driving a lot of the inflation overall. You can see that back in 2022, when inflation was just really going bonkers, there were a lot of different factors that were all contributing to the high inflation. But since then, a significant number of those factors have improved, have faded, or have even become deflationary. You can see the orange and the green bars have actually moved to negative values, to where those prices have been falling recently as opposed to growing. One of the challenges with shelter is it's very persistent. People don't change their mortgage payments very often. People don't renegotiate their rental contracts very often. It's typically once a year, if that. And so inflation in the shelter, in the area of shelter, tends to be very sticky. It means that it doesn't change very quickly and it tends to lag the rest of the economy. So while we've seen inflation come down in other areas, inflation has been consistent until this last report we saw for December. And in fact, there was some enthusiasm in the last 3 weeks in the stock market about the fight against inflation. And at least a portion of that was because we started to see some of this shelter inflation easing. So with that said, this is why housing costs and shelter has been a big focus for the Fed. The other point I want to make is that for the average household, for the average consumer, food, energy, meaning gas prices and a few other things, and shelter tend to be the most tangible tangible prices in their actual budget and lifestyle. So in a lot of ways, the average person pays very close attention to the food and energy and shelter inflation and can sometimes overlook the other inflations. This can be good if food, energy, and shelter are doing well. If there isn't a lot of inflation there, it can create optimism for consumers. But like in 2022, where food was getting more expensive, gas was expensive, shelter was getting more expensive, those three things really drive home to the consumer how expensive their lifestyle has become. So as we continue to fight inflation, those are three key areas to watch: is the inflation in the food, the energy, and the shelter portions of the CPI, the Consumer Price Index. All right, Ryan. So speaking of inflation, this brings us to the 10-year US Treasury. So the 10-year US Treasury gets a lot of attention, more so than some of the other treasuries, say the 1-year or the 30-year Treasury. And part of the reason for that is because the 10-year Treasury kind of represents the intermediate to long-term costs of borrowing. So more specifically, mortgage rates tend to be tied, or at least tend to be correlated very highly with the 10-year Treasury rate. So as we see the rate on the 10-year Treasury go up, we tend to also see mortgage rates rise, and vice versa on the other end. So one of the important pieces for this graph, one of the important takeaways, is that the blue line represents what we call nominal yield. This is the actual interest rate or the actual return that you receive in dollars, in today's dollars. And the gray represents the real yield. So the real yield means if you take the dollars and you correct them for inflation, that's what's left over. So if the interest is growing at 4% and inflation is 4%, then the real return is zero. The inflation has wiped out the entire return of that asset. So a lot of times when businesses are making investment decisions, when individuals are making decisions about their mortgages, the real return, the inflation adjusted yield, tends to be more impactful, or at least of more significance than the nominal. So with this 10-year Treasury rate, we've seen yields climbing, and we've seen, as inflation reduced, we've seen the real yields increase as well. Ryan, can you hit me with the next one? So the 10-year doesn't get all the attention. It does get a lot, but we also have this tool that we refer to as the yield curve, where we look at the yield or the return on all of the different US government debt. And actually, one of the most important points to this curve is the shape of the curve. So in a normal world, we have what's called an upward sloping curve. So short-term rates are smaller than long-term rates, meaning that if you were to purchase a 3-month note, a 3-month Treasury, you would get a smaller return on that 3-month investment than if you were to purchase a 30-year Treasury and make a 30-year investment. This is how things normally work, in part because of risk, in part because of interest rates and inflation. But sometimes they don't work this way. And what happens is when you see a yield curve where the short-term rates are higher than the long-term rates, this is a warning sign typically. This usually suggests that there is some issue within the economy that's causing the short-term rates to be higher than the long-term. This could be a battle with inflation. And in fact, this is what we've seen recently since 2022, is that as the Fed fought against inflation, we saw this inverted yield curve where they had artificially pushed up the short-term rates to try to slow the economy and fight the inflation. And the long-term rates had not necessarily adjusted in the same fashion. So in 2020, you can see that we have, towards the bottom of the graph, you can see we have this kind of normal upward sloping curve, right? But in 2022, we start to raise interest rates to fight the inflation. By 2023, this has created the green curve for July that gives you this inverted or kind of upside down shape to the graph. By October, the fight against inflation was highly effective. And in fact, in September, we saw the very first interest rate cut of this cutting phase. So by October, we started to see this curve flatten out a little bit, where the short-term rates were starting to fall a little, long-term rates were climbing a little, and where we are today, we've actually seen that inverted yield curve become a more traditional yield curve and actually take on that upward slope that we would normally expect to see, and hopefully suggests a stable growth and a stable inflation in the future. If you'll give me with the next one, Ryan, thank you. So the fixed income, the debt side, the bond side of the markets, there's a lot of different choices in the form of debt. It could be based on maturity, so a 10-year versus a 1-year debt product, or it could be whose debt you're purchasing, whether it's a corporate bond or a government bond. But the thing that I wanted to draw your attention to in this red rectangle that we have is that the return on these different types of debt, these different fixed income assets, varies pretty significantly. So each of these different products responds differently to inflation, responds differently to changes in interest rates, and has a different risk profile. So we imagine that government debt is some of, if not the most safest debt that exists. The government is almost guaranteed to pay back that debt. Whereas corporate bonds, or what we call high yield bonds, tend to have a little bit more inherent risk that there may be a default and they may not get paid back. So as we look at fixed income, we try to understand the risks and returns. How much risk is there if an interest rate changes in the future to the value of these fixed income or bonds? And how much risk is there of default, as well as the impact of inflation in the future? So right now, JGUA, just for reference, we tend to invest in relatively short-term bonds. So we tend to look at bonds around 2 years. I think our average maturity right now is 2.5 years, in part because the shorter the term of the bond, the less volatile it is when the interest rates change. Whereas those 10-year, 20-year, 30-year bonds, they tend to be highly volatile, even with just very small interest rate fluctuations. So we tend to look for that stable opportunity, and we've had actually a lot of success in Q4 with these intermediate term bonds. Next one, please, Ryan. So I want to make sure we have time for questions at the end. So I am going to move through these economic slides a little bit faster. So gross domestic product, it's measuring how much the economy is producing. And in 2024, we had a pretty healthy, a pretty strong performance. The second quarter and the third quarter both were about 3% growth in the gross domestic product. And the fourth quarter, we don't have the numbers, the estimates yet, but the projections are putting it around 3%. And as you can see, that 3% growth for 3 quarters in a row is far more stable than most of what we've seen historically, and is a pretty strong, pretty healthy amount of growth for a stable economy. The one piece I want to draw your attention to before we go to the next slide is consumption. The majority of the US economy is driven by consumption. This is people buying goods and services. And this is why we pay a lot of attention to how consumers feel. How are consumers saving versus spending their money? Do consumers have disposable income to continue to consume goods and services? If we see struggle, if we see a slowdown in consumption, it tends to be pretty impactful to the overall economy as a whole in the US. Can you hit me with the next one, Ryan? So, in order to consume, you have to have a job. Well, at least in theory, we imagine that your job creates your income allows you to consume. So we tend to focus a lot on the employment situation, not only for the well-being of households, but also for the well-being of the economy. So the black line that we're looking at here, or the dark gray line, shows you the unemployment rate. And the blue line shows you the wage growth, or how compensation has grown during that same period. One important thing to notice is that when the unemployment rate goes up, the wage growth tends to go down. And as unemployment comes down, wage growth tends to go up, right? This is kind of a natural phenomenon that we think of in the labor market, and it plays into another economic concept called the Phillips curve. So where we are today, we are coming out of a period of historically exceptionally low unemployment post-COVID, and we have been on a slight increase, a slight growth path for that unemployment since 2022, 2023, somewhere around there. In part, this is one of the concerns that the Federal Reserve had was in July. It looked as though unemployment was starting to grow more quickly, and it caused concern. What we've seen since then is that unemployment has basically sat around 4.1, 4.2% since since August, and has been relatively stable. In fact, in our December unemployment report, we saw about 250,000 jobs being added, which was well above the average for 2024. We saw unemployment fall from 4.2 to 4.1, and we saw this wage growth continue to stay stable at about 3.9%. Next one, Ryan. Which means the vast majority of people have jobs, they have income. It may not necessarily be the perfect job or their dream job, but they have a source of income. And so one of the things that we've seen in conjunction with this historically low unemployment is we've seen a very healthy amount of consumption and growth in how these consumers are spending money. We saw a little dip in it as well, but we've also seen a relatively healthy amount of savings. It is still significantly below the average. In the graph on the right-hand side, the current savings rate is still below the average, but it is a relatively healthy, relatively good place to be in as far as growing the economy for the future. So the next piece, transitioning out of consumption and savings, we're going to move into more sort of big picture economic questions. And of course, in the US economy, one of the big components of our success is our ability to manufacture goods and to sell them both here at home and to sell them abroad, right? Although the manufacturing sector has seen some significant growth in the last 4 years, in the last 6 months, it has been much more difficult for manufacturing. The manufacturing sector, in fact, in the last 6 months, has, for the most part, been in a contractionary phase where they were receiving less new orders, there was less production, and there were sort of off and on again trends as far as hiring and the amount of hours being worked. So in fact, although the overall economy has been growing really well in 2024, manufacturing has, in a large part, been the concern or the point of contention because there has been so much struggle in that area. Next one, please. So one of the questions that was posed was about Trump policies and what the new Trump administration, the impact they might have on the economy. So we wanted to take a minute, we wanted to throw a slide in here about tax that the American government charges on American companies and consumers when they choose to purchase foreign-made goods or imported goods as opposed to domestic goods. So in the past, we've used tariffs to try to raise revenue. We've used tariffs to try to incentivize manufacturing and incentivize job creation in the US. And historically, every time that we've attempted to implement tariffs, we've very quickly learned that that was a bad decision and rescinded that decision. So you can see back in the 30s around the Great Depression, we tried it, realized it was a bad choice, and undid it. We did it again in the 60s, a little bit of a push, realized it was a bad choice, and undid it. Now, we also in the first Trump administration saw a relatively small trade war with China, and we saw tariffs being imposed. And as you can see from the graph, we again realized that these were counterproductive, and we started to undo them. We didn't undo them all. The Biden administration actually created some of their own new tariffs that they added to the picture. But in general, we recognize that the tariffs tend to have benefits and costs, and on average, the costs outweigh the benefits. So the big question with the incoming Trump administration is how much of the tariff conversation is threat or bluster or negotiation, and how much will actually be implemented and the impact it'll have on the economy. Next one, please, Ryan. Last of all, people's perception of the economy, what we call consumer confidence or consumer sentiment, is highly correlated with their political beliefs. So when the Republicans are in control of the government, Democrats tend to feel more discouraged and like the economy is doing worse. And the reverse is true. When Democrats are in control of the government, Republicans tend to feel discouraged and that the economy is doing worse. So one of the interesting things is you can see coming into the election in November, Democrats were feeling more confident than Republicans were about the economy. And in the November report after the election, you already see these two flip. So if we had the November and the December numbers in this graph, you would see that now Republicans are highly enthusiastic about the economy, while Democrats are still apprehensive and are growing concerned. So the reason I mention this is because it is really important to separate your political beliefs from the actual condition of the economy and the markets if you're thinking about investing or you're thinking about the future financially. It's quite possible, and I know that I myself am guilty of it, it's quite possible that our political beliefs may be biasing our judgment and may cause you to take an action that you wouldn't have taken otherwise because you are concerned about the future or you are enthusiastic about the future, and that may be driven more by politics than by actual substance and data.